This video, I want to highlight the tax implication of participating in a dividend reinvestment plan. It has tax implication I want to take into consideration. And number one here is taxable dividends. Taxable dividends. Dividends are taxable. So even though dividends are reinvested to purchase additional shares through a dividend reinvestment plan, they are still considered taxable income. So the IRS treats reinvested dividends the same as cash dividends, meaning you must report the dividend income on your tax return. You equally have qualified and ordinary dividends. If the dividends are classified as qualified dividends, typically from the USM corporation or eligible foreign companies, they may be taxed at a lower rate, probably around 0 and to 15 to 20%, depending on your income. Ordinarily, dividends which do not meet the requirements for qualified dividends are taxed at the same rate as ordinary dividends. Number two is there's no immediate capital gain tax. The capital gain tax is not immediate. So in this case, we consider the fact that there is no tax on reinvested shares. There is no tax on reinvested shares. When dividends are reinvested to purchase more shares, you do not incur capital gain tax immediately. The tax event occurs when you sell the shares, and the gain or loss is calculated based on the difference between the sell price and the cost basis on the shares. You also consider adjusting cost basis. The cost basis of the additional share purchased through the dividend reinvestment plan will be the price at the time of reinvestment. This means that each time dividends are reinvested, the cost basis of your holding increases, which will affect the capital gain tax you owe when you eventually sell the stocks. Number three, record keeping for dividend reinvestment plan shares. Record keeping for dividend reinvestment plan shares. So you have tracking dividend reinvestments. You need to track dividend reinvestment. Since each reinvestment represents the purchase of new shares, you must track the cost basis of each set of shares purchased. This can become complicated, especially if dividends are reinvested over many years. So this can become complicated, actually, considering the fact that you invest these dividends, year in, year out. They are invested over the years. So keeping good record is crucial to accurately calculate, capital gains or loss, when you eventually sell. Keep your record because from that record, you'll be able to accurately calculate what you ought to pay as capital gain tax. You equally need to consider brokerage statements. Many brokerage and provide statements detailing the number of shares purchased through dividend reinvestment plans, along with the cost basis for each purchase. It's important to maintain the statement for tax reporting purposes. So you carefully and meticulously maintain you know, your statement, because you will use it for uh, you know, for tax reporting. Please like this video and subscribe to this channel. Number 4 is tax deferral in retirement account. Tax deferral in retirement accounts. So you have what is called a tax deferred account. Tax deferred account. So if you participate in a dividend reinvestment plan within a tax deferred account, such as an IRA or a 401k, you won't pay taxes on the invested dividends until you withdraw the funds. You don't pay tax until eventually when your funds are, when you eventually withdraw your funds. So in this account, the dividend can grow tax deferred, and you will only pay taxes when you withdraw the funds. You know, at the applicable rates, you end up paying tax at the applicable rates when the funds are eventually withdrawn. Based on your account type, the type of account you are maintaining. You also need to consider tax-free growth. Tax-free growth in Roth account. There's that tax-free growth if you're running, a Roth account. In a Roth IRA or a Roth 401k, dividends invested through the dividend reinvestment plans will grow tax-free, and qualified withdrawal are also tax-free, making this an advantageous setup for long-term investor. These are very interesting. You carry out your withdrawal tax-free because of the nature of the account. Number five is taxable accounts and dividend reinvestment plans. Taxable accounts and dividend reinvestment plans. We've just considered tax deferral accounts and even tax-free growth accounts. This time around, we are considering taxable accounts, and dividend reinvestment plans. So in this case, you talk about annual tax liabilities. Annual tax liabilities. For those using taxable account, participating in dividend reinvestment plan means paying taxes on the dividends annually, even though the dividends are not received in cash. This can result in a tax bill even if no money is physically received. You've not really collected any money through dividends, and yet you are still expected to pay tax. So we also need to look into impact of dividends on income, impact of dividends on income. The tax rate applies to dividend depends on your overall taxable income. For those in the higher income tax brackets, they'll be taxed at a higher rate. And for those at the lower tax income brackets, they'll be taxed at a lower rate. Even if the dividends are reinvested, those tax rules still applies. The rules still apply to them. Number 6 is state taxes. State taxes. There is this state tax implications. In addition to federal taxes, some states also tax your dividend income. So if you live in a state that levy taxes on dividends, and you happen to be on a higher income tax bracket, then you will need to report your dividend income, on your state tax returns. Number 7 is potential for complicated tax filing. Potential for complicated tax filing. So this particular complexity when it comes to filing your taxes. If you are reinvesting dividend through a dividend reinvestment plans, over many years, the calculation of your cost basis can become a little bit complicated. So each reinvestment, increases your cost basis as you keep on investing regularly through this particular plan. Discover that your cost basis will continue to increase, which must be carefully tracked to accurately calculate your capital gains when you sell the stocks. Because if you keep an accurate record of your cost basis, you'll be able to accurately calculate your capital gains. So this can be a time-consuming process, without good record keeping. So you need to be very meticulous in your record keeping, because at the end of the day, you end up paying your overall taxes based on, the cost basis, based on the amount you invested in the initial stage. That will determine, the level of tax you will pay as capital gain tax.